No, they would only go to the children's hospital.
All of it.
It's huge. Chief of guys trained in red. He is certain.
So that might come out of there.
They will go there. He's got a huge time. So people take care of all this stuff.
Tested the clicker yet? You have a clicker. Were you going to use? I'm going to use that. I'm just starting right here. Yeah, just use it for 5 now. Red light. Okay. Thanks.
I think they will.
Jared. Jared.
Yeah.
That was, who was that?
Hey, Jared. Rick, how many more people are out there? Huh?
He's blind out there. No.
Okay,
Hey, why are they so back?
I'm gonna get started.
They apparently had hired process.
Okay, as you're aware, this is what we refer to as a lunch and learn, but we hope you're enjoying your food. And on behalf of Legally Mine, my name is John Melton, and I would like to welcome you out here and hope you do enjoy this meal. More importantly, I know you're going to be able to enjoy some of the things I'm going to share with you as we go through this. These are the critical things that they don't teach really in medical school or when you're in your residency or in your own practice or working for others. They just don't teach these things. And these are the things that are very critical when it comes to business or comes to life and trying to keep what you got. So I'm going to go through a lot of information as I go through this. Some of this will apply to some of you, some to others, but I can promise you if you, the two objectives that I have, if you want to go with that, this is going to be awesome as we go through it. Let me just say that I grew up in Southern California. After graduation, I went to a university, I had an opportunity to play football there. And I also met my girlfriend, and she is in fact in the back right now. Turn around and say hi to Julie. Hey, Julie. She's my girlfriend, and she also, fortunately, is my wife. We've been married this June 40 years. We've enjoyed our time together, but I have learned over those 40 years of having my own businesses, some of the most important things that we can do as far as, like I said, trying to make as much as we can and keep as much as we have. As I go through this, I do get a question sometimes when people find out that we've been married that long and they ask, do you have kids? Do you have grandkids? And we do have 5 children, and we have 17 grandchildren. And I can tell you that I learned a long time ago that everybody always told me, well, you got kids, they're fun and this and that, but when you get grandkids, they're more fun than kids. And I agree. So here's some of our grandkids there. And it's an awesome experience to be able to share with these. We have another one coming this July, so we'll have 18 grandkids. Now, today's objective is real simple. First, show you how to put more money in your pocket. Does that sound okay? I've never had anybody argue with that, so hopefully that's good for you. Also, how to create legal strategies that are going to help you keep what you earn. And this is really important as some of you are at the beginning of your career, some of you are at the end of your career, in the middle, but just keeping what you've been able to accumulate at this point. I think everybody here would agree that the United States is a very litigious country. Statistically, if you're not aware of this, it's frightening. Every city that I go into, and I travel over the United States and I talk to groups like this, I see these kind of billboards. I found out there's two people that want our money. The first group that wants our money is the IRS. And they, I think today, I would say that they seem to think that our money is their money and they want it all. But that's another story. We'll talk about that in a few minutes. Let's get into the other group of people, and that's attorneys. Trial attorneys want your money. And it's become an epidemic in this country. It is frightening what is happening throughout this United States. The United States only has 5% of the world's population, and yet they actually have 90% of the lawsuits in the world. 90% in the United States. Last year, 100 million lawsuits. If there's 350 million people, that's 1 out of 3.5 people are going to be sued. Obviously, statistically, you look at the person to your left or to your right, one of you three are going to be sued. Some of you are probably in a lawsuit. Some of you have been sued. But ultimately, we're going to show you what to do to really take care of this and try and make it so these lawsuits don't happen anymore. How do lawsuits work? There's a really simple way to explain it. There's a cause, and of course, there's the motivation. Now, here's the thing. The cause we can't do anything about, because believe it or not, there's going to be a cause in every case. There could be a slip and fall. There could be your own employee suing you. It could be a car wreck. All these different things are the cause, and we just can't do anything to really change that. But the motivation is what we can change. And what do you think is the biggest motivation for a lawsuit? Any idea? Money. Yeah, it's money. That's what the motivation is. So we can focus on that. What do you think is the worst way to protect your own asset? Having your own name. Now, I'm going to ask you a couple of questions, and some of these might be rhetorical, but these are questions that I would like to get an answer on. How many of you right now own your own home in your name? Raise your hands. Let's see. Okay. If you own your own home and it's in your own name, be aware that that can be taken from you very, very easily. And in most cases, it will be if there is a lawsuit because of the things that judges are allowed to do in the United States today. So I'm going to go through and explain to you how to protect that and how you can protect it so that somebody can't get that from you, other than if you live or work in the state of Texas or Florida. But there's some things that are important to learn about that. Any assets that you have, it's like you have a billboard on your back saying, come and take this from me. And the reason why, when I talk about these attorneys and the 100 million lawsuits just in the United States last year, do you think these attorneys are suing wealthy people, or do you think they're suing broke people? They're going after the wealthy people. They're not going after the homeless. And so my job as we go through this, in a joking way, kind of, I'm going to show you how I'm going to help you become penniless and homeless. Now, this is important to understand that, in fact, one of my coworkers, Jarrett, was just explaining to me, he's reading a book that I had read years ago, Rich Dad Poor Dad. And in this book, it explains a little bit of what we're going to chat about today. And that is, if I can have you become homeless and penniless, at least according to the books and according to the courts, then lawsuits won't continue at that point. It doesn't matter how much you have, it's how it's actually set up. And here's one of the things that I found is super important when it comes to asset protection, the correct entity for the asset. If I told you just in the last year of the tens of thousands of people I've seen, I can tell you that it's amazing how many have an asset in the wrong type of entity to actually give it the protection that they need. Also, the correct state for the maximum protection. When we're dealing with clients in California, for instance, it's scary how many times I've seen these clients that have been set up by attorneys or accountants, and they've been set up to protect their assets, especially land, property, homes, and they do it wrong. And it can really cause a lot of issues. Like in California, they have a Prop 13. You buy a house in 1980 for $40,000, and then you sell the house today, or you don't want to sell it, you want to keep it. Well, today that house could be worth $4 million, and it happens all over Southern California. But at a $4 million house now, if you change that into an LLC and don't do this correctly, then you now trigger Prop 13, which means that instead of paying taxes on $40,000, now you pay taxes on $4 million. And there's a very, very special way it has to be done. That's what we specialize in. We've been doing what I'm talking about right now for years and years and years. The gentleman that started this a long time ago, this guy by the name of Jay Mitten, he is known as the father of asset protection, fantastic attorney. Unfortunately, he passed away a year ago, but just awesome what he's done. Some of you right now probably have things called LLCs. How many of you have an LLC? Raise your hands high. Let me see. If you have an LLC or a PLLC, let me be clear. 100% of those that we review on our new clients as we onboard new clients, 100% of them, the verbiage is wrong. And with that wrong verbiage, I'll prove to you how important it is to have the correct verbiage, and it can be amended. But we end up doing that with 100% of the ones that we look at. As we're going through this, we're going to show you how to break up assets. And it's important you understand how to break these assets up, safe assets and risky assets. Here's a major problem that we see happen all the time. And that is when it comes to these types of assets, you might have an attorney or an accountant tell you, the best thing you can possibly do is stick all your assets into an LLC. And people do that. Well, the problem is if the LLC isn't the right one for the state, if the LLC isn't the right one for the properties or the assets, there are so many complications that can happen, but we have specialized in this. Our experience, I'll just say the last 15 years, we have 15,000 clients all over the United States. We work in every state, and the majority of our clients are in the medical world. That's just our wheelhouse. It's what we really specialize in. And because of that, we have such a fine-tuned expertise in working with you. You are the group that we like to work with and that we look for. As we break up these types of assets, this is something you need to be aware of. These are what we consider safe assets. When we talk about these safe assets, just so you understand, these are things that cannot cause a lawsuit on their own. So we can group all this together: cash, precious metals, cryptocurrency, IRAs, 401ks, bank accounts. Just think about it this way. If I could show you, because these all can't create a lawsuit, but if I can show you how to take these assets right here, doesn't matter if the value of it is 100,000 or 1 million or 10 million or whatever it is. But if I can show you how to create or have an entity that we can put these assets into, and it's a vault, so to speak, and then lock it up and give you the only key, and it would guarantee you 98% protection on all the assets in there on $1 million. That means that if somebody came to you for a lawsuit, all they could ever go after is $20,000 of $1 million. Attorneys will walk away from that kind of a deal. Lawsuits don't continue, but we're good at this and we know how to do this. And I'm going to show you how that actually can happen. Jay Mitten, years and years ago, when he had all his clients, he was looking at this and he said, we got to find a way to protect them. So he found this entity back in 1916. It was created. It was for the transfer of wealth from parents to children without having a big taxable event. And the way these family limited partnerships work is brilliant. In fact, I would say, is anybody in this room right now have a family limited partnership? Every one of you should. Every one of you should. And let me tell you why. Best way to protect your cash, best way to protect your retirement accounts, the best way. Let me explain how it works. Basically, there's limited partners in a family limited partnership. They have no control and no liability. Because they have no control, no liability, they cannot be taken to court in any state in the United States. No control, no liability. However, there's a general partner. A general partner, the way it's set up is a little bit different. General partner have 100% control and 100% liability. Now, the key to this thing is that you, your spouse, your kids generally are going to be the limited partners, but the general partner can be you yourself, it can be your spouse, it can even be a business partner. Here's the cool thing about this. The reason why this has such great protection is we know limited partners can't be sued, but the general partner can be. So it is set up this way that limited partners will own 98% of the asset, and yet general partners will only own 2%. And there's where you get your protection. Now, Jay did this. He started it with his clients back in the 60s, and other attorneys, judges even didn't understand these FLPs, didn't understand how they work. So they started taking him to court. He went to court a bunch of times. He had to keep going to the Supreme Court or Court of Appeals. He eventually took it to the Supreme Court. And the great thing about this for you and for I is that when the Supreme Court looked at this, they voted in a 9-0 in favor of the FLP, which means it is completely backed by the Supreme Court on a 9-0 vote. These are powerful entities. Everyone in this room needs to get one. Wherever you get it, get an FLP. Make sure it's set up right for where you live. Having said that, the states got a little ticked off because when the FLP was set up this way, it worked great for us, but the states didn't want you to be able to be a general partner and a limited partner. So they said, we got to break that up and do things a little bit differently. We said, no problem, we'll do that. What do you need us to do? And they told us, and we do it now. So we do these FLPs with almost every single client we have. And all we do is just have a management company that's going to take care of the general partnership. Obviously, you can be the person that owns that general partnership through the management company. Now, here's something kind of unique. With these management companies, how many of you in this room are W-2 employees, get paid as a W-2? Raise your hands, let me see. Okay, those of you that raise your hands, if you don't have any other income, no side businesses, nothing else going on the side, but strictly you just get W-2 income from your employer, one more time, raise your hands. Okay, most of you that have raised your hands then, what's happened either right now throughout your entire career or will happen the rest of your career is you're happy because you're getting your money, you got a job, you feel secure, everything else, but you will not be able to take advantage of all the tax deductions that are out there, the wonderful tax deductions, being able to write things off like your cell phone, being able to write off your vehicle, taking a corporate trip to Hawaii. Does that make sense? These are the things that all these W-2 employees that I talk to all the time were like me. W-2 employees happy getting your money, but not knowing how to take advantage of all these tax deductions that are out there. We're going to blow your mind as I go through some of these different tax deductions today, and you will see how this is something you probably are going to want to take advantage of if you're thinking clearly, and if you want more of your own money. But the way we do it is very simple. Even as a W-2 employee, I will show you how we can just take that management company, and with a management company, we can actually use that and have that function as another company for you. We can show a loss on that management company every single year. But at the end of the day, it's going to reduce your tax burden for you individually off your W-2, which means your total amount of income coming in as a W-2 employee is going to be more because we will set that against your personal liability of taxes. I'll get back to that a little bit later. Let's talk about risky assets. Important to understand, there are major mistakes being made all over the country. I can't tell you how many times I've talked to doctors that have come up to me and said, hey, am I doing this right? Because we have rental properties and we put them all into an LLC. Probably one of the worst things you could do with rental properties. And I'm going to explain why. These different types of risky assets need to be separated. They need to be separated the correct way and put into the right entity. Jay Minton, he loved the FLP, but he said we need to get an FLP, kind of the same thing with a little bit more flexibility, and we need to do it somehow. And he had 3 other attorneys up in Wyoming that had worked for him, and they said, can you come up here? We want to create this new entity. So they went up there, he went up there, met with them, and they created the first LLC. I think it was 1978 is when it was created. That LLC was the most popular, is the most popular entity in the world. 3 years later, every state had a form of an LLC. Today, 100 countries have LLCs, some form of it. But what we do is because all of these can create their own lawsuit, it's important not to put them together. And yet I see it every single day. So let's go ahead and just talk about an LLC for a second. The only reason LLCs were created, no matter what anybody's ever told you in the past, I am speaking from the expert that created them, Jay Minton. He said the only reason we created these LLCs was for asset protection. If you're getting taxed on these, if you had somebody create your LLC, if you had somebody do it, or if you did it yourself, go onto a state website, get into the template base, create your own LLCs, LegalZoom, anywhere you've gone to get it done. Most of these LLCs, when they're created by attorneys for attorneys. So attorneys can basically rub each other's back and they can get into your LLC. We want to show you how to lock it down and tight so that nobody can get into that thing. But ultimately, when you get taxed, if it's a template base or somebody built your LLC for you, what's happened in most cases is that they're going to be taxed as a sole proprietor, which means you're losing a lot of money. And I'll show you how much money you could be losing being taxed as a sole proprietor, but you can tax as a partnership, S Corp, C Corp. Our suggestion would be the S Corp. You can elect to do that. You can change that every year if you want to. Now, we covered a little bit about that. How's the LLC protect? There's a thing called a charging order. I'll get into in a minute, but the charging order is what has been issued through these courts. And it was issued initially with every single state. And what it did is it gave huge protection to the LLC, and it blocked the judge on being able to do things that judges want to do. And it's very, very powerful. Strong charging order in every single state. It was passed in all the states. It's supposed to allow the judge to only take anything out of that entity if there's being a disbursement made, but they can't go into an LLC and take assets out of there. All they can do is if there's a disbursement being made, a distribution, then they can go and take that money and they can award that to the plaintiff, or they can actually take that money, garnish wages, do what they want to do in that case. And that's the way it was set up. So it was massive protection on these LLCs, wonderful entities. Here's the misuse of it that people use all the time. They get multiple entity or multiple assets into the entity. For instance, I deal with this again all the time where clients will come to us and tell us, hey, we have office equipment, or we have an office building, or multiple office buildings. We have a home, we have rental properties, we have cars and toys and boats and all these wonderful things. Well, I think they're amazing. However, put them in the same LLC, and this is what can happen. You have an issue in one, somebody gets hurt in that one, they sue you, and a judge will group everything together, and you really are in jeopardy of losing every single one of those assets. There was a doctor that had a patient in his office. He finished the clinical treatment that was going to happen. Patient walked out of the office. On the way out, gust of wind comes up, hits the door. The door hits her on her way out of the office, knocks her down. She complains she can't walk. She's having trouble with her back. She gets a PI attorney, and this trial attorney takes the doctor to court. And if you and I were pals, we're sitting on a bus or a train or sitting out in the lobby just talking, and I told you about this case, and we both probably say, this is insane that this is happening. But the fact is that they went to court. The judge found in favor of the plaintiff and awarded her $5.14 million. Now, it sounds ridiculous, but the thing is it's real. So was this doctor protected? My assumption is not even close, because initially his first insurance that he had to use paid $1 million to her of the 5.14 million. He had a general liability on his office that paid another $1 million to her. But then the judge was able to, because of the weak charging order, was able to go in there and take everything that he had, every asset he had, put it up for auction, sell it, award all those funds to the plaintiff, and he still owed $1 million to her after everything he had, he lost. The scary thing is that because of this charging order and the weakness of it in the state he was in, the judge was able to go in there and then take charge of any distributions and garnish wages and tell the doctor, this is the X amount, this is what you can make the rest of the year, and every year after this until she has paid off that other $1 million. Doesn't sound right, and it's not, and we don't want you to ever have to go through this, but I promise you this, do not be the one that says, I'm never going to get sued. It happens, and we just know it does, and so we just say, let's just protect you so you can sleep every single night and never worry about this stuff. That's what one of the benefits of being able to work with us is, but get it done somewhere, even if you didn't work with us. Having said that, this is what we would do. We would take these assets and put them into separate entities. And when they're in separate entities, you have an issue with one, that's it. It stays with one. That doesn't affect the other ones. Now, who uses that kind of a strategy? Pretty simple. Disney does. Disney, they actually have a lot of rides there. If you've been to Disneyland, Disney World, you know what I mean. You might not know this, but each one of their entities is in a separate LLC. So if you went into a ride like the Matterhorn and hurt yourself, you can't sue Disney because they have a separate LLC for every one of these rides. And you don't pay a dime to get on that ride. You pay money to get into the park, but not on that ride. And that's how they've done this protection. They spend millions and millions and millions of dollars with their attorneys to make sure this is set up and it is done in a perfect way. We mimic exactly what they do because it is the best way to do asset protection. If you have not been shown this by your accountants or your attorneys, I would say shame on them, because this is the way it needs to be done. And if they know true asset protection, this is the way it would be done. Now, let me show you another example. Walmart, you've probably been to Walmart. You understand they have a parking lot and a store. Of the parking lot and actual store, where do you think most lawsuits come from? Parking lot. And guess what? Every single parking lot is a separate LLC. How much do you pay to park at Walmart? Nothing. So the fact is that you're not going to be able to sue that entity. At the end of the day, again, it is a strategy that works. I always get the question of, why don't you think my people, my accountants, my attorneys, whoever it is, why did they set us up this way? I don't know. But I can tell you this, a lot of times it's not because they wanted to put you in harm's way. It's because they maybe didn't know, they weren't aware. At the end of the day, this is the way it needs to be done. So the key to being able to do this properly is to have a holding company. And real simple to explain why holding companies are powerful. It's because when they spent all this money getting these attorneys to put this together, this is what they decided is the best way to do it. 49 states that have these holding companies or have LLCs that could be created into a holding company, they have weakened the charging order in 49 states. There's 2 states that I would say you probably are okay still working with. What would it be? Delaware. And if you have a C Corp or you're going to go public, you need to be in Delaware. If you want to have a LLC in another state, you could do it in Wyoming. Wyoming is very innovative. They're cutting edge. I set up a couple of LLCs there a little while ago with cryptocurrency. They're pretty good, but the number one state to actually do this in is actually Alaska. I have a S Corp in Alaska. I can tell you that it is the best possible protection. Let's go ahead and talk about what can happen in your state right now. Pay attention to this because this is in every state. One of these three things can happen to your LLC if you're not aware of that. They can dissolve your LLC, and if they dissolve your LLC, that means that you no longer have that protection, that shell around it. So where do all the assets go once the LLC is dissolved? It goes right back to who? Right back to you. And if you want to personally, the judge can take that from you, put it up for auction, or award it to the plaintiff. In fact, in a lot of states, they can just seize assets right out of the LLC, and they can give those assets to the plaintiff. And the last one is something that shocked me when I first learned this, but they can actually foreclose on your membership in your own LLC as though it were property. And once they have the ownership of that, they can award that ownership to the plaintiff, and you no longer have the LLC, they own the LLC. And if they own the LLC, they own all the assets in the LLC. So they now have the opportunity to take that and do what they want to do with your assets. Even if it's your home, they can boot you out or maybe charge you rent to stay in your home. But ultimately, this is the power that they're given because these charging orders got weakened so badly. It frustrates the heck out of me, but I said, there's got to be a way to fix this. There's got to be a way to get around this and make this still work. And there is. There's wonderful ways to make this happen. This weak charging order is really the key to it. So let me show you something with these Alaskan holding companies. They actually are not going to do these things because they still have a very, very strong, the strongest charging order in the country. And it's a great resource for them financially, but it's a great resource for us, those of us who are trying to protect ourselves. Plus, every one of these LLCs or S Corps or anything we send to them, they hand approve, which really helps if there's any lawsuits that will come. They can prove that they hand approved every single one, and they approve the verbiage that we put in these, which gives the ultimate protection that we're looking for. Because these trial attorneys are looking to take control of your money in a lawsuit, they love the fact that these judges can actually do what they want with these distributions with a weakened charging order. Let me give you an example of what happens. And this will probably blow your mind, but I want you to understand this is the real deal. This is really what does happen. Here's the way I'm going to do it. Let me give you an example of some verbiage that is actually out there. And this verbiage, just so that you're very clear on it, not every single LLC that we come up against has this verbiage, but when this verbiage is there, it is a big problem. So let me go ahead and give you an explanation of what I'm talking about. This is called a pro rata distribution clause. And to give you an example of how this pro rata distribution clause works, it actually awards the judge financial control over the entity and allows the judge to distribute funds and garnish wages. So this right here is because it's been a weakened charging order, but then also with a verbiage, it becomes a huge problem. Now, I'm using an example. What's your name? Catherine and Emily. Let's say that Catherine's going to sue Emily. In that case, if I'm the judge in the case, I'm going to listen to this case and I'm going to award somebody at the end a win in that case. In this situation, we'll just say that you're going to sue Emily for $1 million. Now, you want $1 million, right? But you don't want to give it to her. No. But you want the $1 million because of the lawsuit, obviously. So let's just say that I like you because I like your sweater that you're wearing. And so you're going to win $1 million. Now, in this case, if Emily is not protected correctly, I can go in there and I can take charge of everything that she has. I can look at anything she wants. Do you know that in most states today, as soon as you go to court, the judge dissolves your LLC? In most states, just dissolve it. So now I can take a look and do whatever I want to do with this, especially the financial aspects of this. And that's the way it works. So I can dig in her pockets, find $1 million, and I can award that to the plaintiff. But here's the key to it. What if Emily had been protected the correct way? Whole different picture. Because even with something as simple as this verbiage right here, this is what we find in every single LLC we look at. We actually can amend that and change that. Let me show you the difference here and how powerful just this verbiage is. We changed that to what we call a non-pro rata distribution clause, which effectively blocks me, the judge, and stipulates that only the general partner can order a distribution. So in this case right here, lawsuit still goes, still for $1 million. She doesn't want to give $1 million up. She's protected herself in the proper way. She has the right verbiage. So in this case, there's no way that I can get in and get her money. Absolutely no way I can get her money. unless she makes a distribution. Now, if she makes a distribution, then I can take control of the financial part of that company and I can take that distribution, garnish what I want out of the distribution and award that to the plaintiff. And I can do it every single time she makes a payment or a distribution, I can take that money from her. However, if she never makes a distribution, I have no access to that money. Are you ever going to make a distribution? Never going to make a distribution? Wait a second. You want to get money, don't you? How's she going to get paid? Easy. Because she's the owner of the company. Everybody agree? Yes? If she's the owner of the company, all she has to do is ask the owner, who she knows personally, can I take out a no interest loan? And even though you'll let me have this no interest loan, just understand I'm never going to pay you back. And guess what the owner's going to tell her? Sounds good. How many loans do you want? She can make herself as many loans as she wants, no interest loans with no expectation of ever paying them back. She could pay her spouse a distribution, but she cannot pay herself a distribution, so she's never going to do that. Now, in that case, I'm sorry to tell you, you're never going to get any money. Lean. Ugh. Is that okay? Well, it actually gets worse than that. It gets worse for this reason, because the IRS got involved with this and they said, if she gets $1 million, we want to get some of that million. But in this case, she's not going to get any money because she's never going to make a distribution. She just told you that. So because she's never going to get any money, IRS went to Congress and said, here's a bunch of money. Will you change the laws? And Congress said, sure, we'll change them. So they changed the law now, and I think it's 77-137. And they said now with this IRS ruling that even though she's never going to pay her, she was awarded $1 million in the lawsuit. So she now is responsible for $1 million, the taxes on that $1 million. And she probably is going to have to pay the taxes on $1 million. Sound good? This is the crazy part about this. In fact, in this case, who are you going to sue next? Probably the attorney, right? Because the attorney probably in that case got so greedy thinking of $1 million lawsuit and the money going into their pocket, they didn't do their discovery the right way. They didn't really dig in and find out they had a non-pro rata distribution clause. This is the type of thing that we do to help protect our clients. And because when we do this the right way, no lawsuits continue. IRS ruling 77-137. No lawsuits continue. This is where our expertise comes from. Now, having said that, let me go ahead and show you something else. I want to talk real quickly about estate planning. How many of you in this room have a will? Raise your hands. How many have a trust? Okay, let's just break them up for a little bit. When it comes to a will, this is the best way to explain it. Wills can be contested before and after death. That means that anybody can contest your will before, or anybody can contest your will after death, and it's frustrating. In fact, you probably have heard of this. Have you ever heard of these families where they have siblings that have fought for years and years and years over a will, and everybody's fighting because they don't think they got the fair share? Anybody ever heard of those types of families? Happens all the time. My wife and I have 5 kids. You think there's a chance that if I died tomorrow, one of my children might think they were treated unfairly in a will? Yes or no? Yeah, and I know which one. The fact is that this is the real deal. So if you have a will, that's great. That's fine. We create wills for our clients all the time. But ultimately, what you're trying to do is figure out what's the best protection? What's the best way to have this stuff set up for future generations? Well, let me just tell you real quickly, because it's not difficult once you understand this. Real simple. You can have what's called a revocable trust, or you can have an irrevocable trust. To put it in a nutshell, irrevocable trust cannot be modified. Probably one of the worst things you could do in most cases, but in some cases, it's not a bad idea. Revocable, this can be modified before death. After death, it's in concrete. You can't do anything with it. We love trust. Trust is a very powerful entity and something that you should think about. With our clients, we will always set them up with a trust because we understand the power of those. If they want to do that, we can set them up with that. If you have a will, again, they can contest that before and after death. If you have questions on that, we can talk about that later on. You can come by my table, talk to me. But right now, what I want to do is get into tax deductions, and I'm going to go quickly through this. If you have any questions on any of these tax deductions, that's a good thing. Come by and talk to me or any one of my staff, and we'll be able to help you through this process. But basically, the IRS tells you right now, if you want to get tax deductions, it's up to you to find them. Here's the code book. Good luck. And because of that, 73% of Americans overpay in taxes. Let me go through a few of these. First of all, for those of you that are paying yourselves, how many of you have your own business and you're paying yourself as a 1099 employee? Anybody doing that, or K1 distributions? All right, how many of you are also paying yourself not only as a 1099, but also with a W-2? Okay, this is the way it should be done. If you're getting paid as a W-2, I'm going to show you some things you can do with that. But just this one example right here, if you literally are paying yourself and you're doing it as a W-2, we always suggest to our clients, you want to split that about half and half. So let's say you're bringing in a simple number, $200,000. $100,000 still pay through the regular process, W-2 payroll service. But the other $100,000, you're going to pay yourself as a 1099 or a K1 distribution, regardless. You're still going to get taxed, but you're not going to have to pay the matching FICA. And FICA for an employer is 7.5%. For an employee is 7.5%. $100,000, that's 15%. That's $15,000. And many, many times I can tell our clients we work with right away, that's putting $15,000 in your pocket every single year from now on if you keep doing those same exact numbers. Very, very powerful thing to do. We can help you and show you some ways you can take advantage of that. When it comes to income shifting, any of you have any kids under the age of 18? If you have kids under the age of 18, you should be paying them through your business. If you have kids going to college, anybody paying kids going to college right now? Helping them? Okay. Here's the thing. You want to pay them through your payroll. If they're younger, if they're under 18, you don't want to put it through payroll. You want to expense it out with your business. How do we do it? If you're a W-2 employee, remember, we're going to use that management company with the FLP. This is going to save you a ton of money in taxes. It's going to give you a ton of tax deductions. And also, even though we can show a loss every year on that management company, it's going to be amazing how much money this is going to put back into your pocket. Let me give you an example. With kids, with these minors, if you pay them and expense it out for your business, or some of you management company, you expense that out, you can pay the kids over $12,000. It's $12,950, but I think this year it's moving to $14,000. You pay them that money. So if you have 1, 2, 3 kids, even with 3 kids, it's going to be almost $40,000 that you're going to be able to pay them through your business, and that's a tax deduction. Now, the cool thing about this is that because it's a tax deduction, that means that depending on your tax bracket, you're probably going to be able to put another probably roughly 10 grand into your pocket every single year by paying your kids through your business. Now, it is a tax deduction for the business. And I get the question all the time, well, what do our kids do? I had a dentist come to me and say, I got a 2-year-old. How can I hire her? Easy. What you need to do is you need to use some social media, because every one of you should be on social media. You also should have, if you have a business, take pictures of your kids, put them up on the wall with holding instruments, do whatever you want to do with that. You can hire them as consultants. This young dentist was all excited about this, wanted to get the tax deduction for it. He took his daughter, and every Saturday he takes her to the office and they have what's called a shredding party. And they just shred all the documents, and she'll sit there for over an hour just shredding those documents because she just loves watching that thing happen. Well, that's what the IRS calls meaningful work. And that's something you can do. If you have kids that are in college, you are spending more money on those kids than if you actually hired them through your business and ran it through your business. You can save more money doing it that way. You have questions on that? Come and see me and I'll explain to you how that actually works. IRS Section 280 AG. This is something that'll blow your mind. Some of you might be aware of this because of where we are in the country. But let me go ahead and say that during the Olympics, what happened is there's a lot of people that didn't have places to stay in Los Angeles in 1984. So the IRS said, we're going to do this thing called the 280 AG, which means that anybody that wants to can let people come and stay at their house for 14 days, all 14 days of the Olympics. And whatever money you get to keep that money. You do not have to pay it in any taxes on it. Sounds great. People did it, but the law is still on the books. Some of you in this room have heard of something called the Augusta Law. Very similar. It's the same thing, basically. That's what they refer to it as. Ultimately, what it means is that right now, everybody in this room, if you have a home, raise your hands if you have a home. Raise your hands if you have a vacation home that you spend time in more than 14 days a year. Okay, you get 14 days. Every one of you gets 14 days. And with those 14 days, you get to charge rent, but you don't want strangers living there unless you live in Augusta, but you don't want strangers living there. So what you do very simply is you're going to rent it out to your corporation. If you have a corporation, if not, you're going to rent it out to your management company. Your management company is going to pay you depending on the size of your home, where it is, the value, everything else. We do calculations on this all the time for our clients, but ultimately what happens, we base everything, every one of our clients everywhere in the country, we start them at $2,000 a day. Now, the reason why this is important to understand is that means that at 14 days, $2,000 a day, that's $28,000. That money gets paid from the corporation to them in their pocket They do not have to put that into their taxes. They don't have to file taxes on it. They get to keep that money, spend it on whatever they want. That's $28,000 a year in your pocket. But you get a tax deduction for it, which is another probably $7,000, $8,000, $9,000 that's going to save you in taxes. So literally, we're looking at probably $40,000 extra money in your pocket this year if you did the 280AG. And by the way, a lot of our clients, they have bigger homes, better homes, more expensive, better neighborhoods. I know clients that are getting 2, 3, 4, 5, 6, 7. I know one that's getting $10,000 a month where he's renting it out to his corporation because of the size and because of the money that he makes. Ultimately, if you're not doing this 280AG, you're missing out on a ton of money in your pocket and it's tax-free. How many of you have interest in the 280AG? Raise your hands, let me see. Okay, those little cards you have on your table there, the little. We're going to do something nice for you here today. If you want us to do the analysis on your property, we have an expert in our office that'll do it for free for you. There's no question we can do it for free. It's simple for us. But if you just fill that information out, we'll get that from you. And then the guy in our office is going to take care of this. He will go through it. He will figure out with you exactly what you can charge for rent. Give you the process of what to do in order to make that work for you. It's a fantastic way to do things. Captive insurance plan ownership. This is something that if you are looking for a way to get a retirement fund where you don't have to have like matching funds with your employees, or you're looking for a way to be able to control things, these captive insurance plans are absolutely amazing. I would say this is the #1 investment I've ever seen as far as retirement plans that I've ever seen out there. With a captive insurance plan, you have to make more than $250,000 a year. We show you the process of what you need to do to set up your own insurance company. You're not insuring cars or homes or that type of thing. What you would insure is something like a downturn in the economy or your reputation. These are the things that you would insure. Because of that, your company or your management company would pay premiums to your insurance company. Those are 100% tax deductible. Just to be clear on this, 100% tax deductible. And that simply means this: you get to choose the investment the insurance company is going to invest in. As long as you keep it in that investment, whether it's stocks, whether it's bonds, whether it's rental properties, whatever it is, keep it in there for a year and a day, and you get to take advantage of capital gains taxes, which is going to save you 50% in taxes by doing it this way. I get the question all the time: how much can we pay in these premiums? There's no minimum, but you can pay yourself in these premiums into your retirement account up to $2.4 million a year. Very powerful. And remember, that money, instead of taking it out of your bank account, put it into an IRA or something, it literally is going into your insurance company. So if there's a downturn in the economy, you can pull money out of that. It's tax deferred. With COVID, we had a lot of our doctors that were taking some money out of that. And they actually had it where they didn't have to pay taxes on it when they pulled it out because of the necessity. Licensed professional deductions. This is something, again, if your accountant hasn't told you about this, you need to come by the booth and talk to me, and I'll tell you how this works. Real simple. It gives a 20% income deduction for licensed professionals. And by the way that this is set up and the way that this works is that it must pass through an entity, or in some of your cases, it's going to be that management company. But ultimately, you need to make less than $465,000 a year. So let's just say your business brought in $1 million and you were able to take advantage of this. When you take advantage of this, instead of $1 million, it reduces it by 20%. So it's really $800,000. And so if you were going to pay yourself, let's say $400,000, according to the books and everything, it's going to show about $200,000 that you're paying yourself, but you're still getting the $400,000. So it's a fantastic way, again, to get more money into your pocket. Again, time after time after time with these different types of tax deductions, a lot of times people say, why haven't I ever heard this stuff? This is the stuff I've wanted my whole life. I don't know why, but I know you're hearing about it right now. And if you want to take advantage of this, I'll show you how you can do this. I'll show you how you can do it very quickly. Let me give you an example on this though. If your accountant has not told you about this, or if they don't know about this, accountants have to fill out 7 forms in order to make this work. With our clients, if we have any accounts that say, well, we don't want to go through that hassle or work, whatever, to me, I just get frustrated because to me, accountants in most cases are glorified IRS consultants, basically. All they want to do is they just want to make sure that things are done to comply with what the IRS says. We fill out the 7 forms for our clients, hand it to their accountant and said, file for them. This is going to save them a ton of money. Let's do one last one, R&D tax credits. Now, this is important for everybody in this room. Listen up to this one. This is the last one I'm going to do, and then I'm going to tell you how we do things as a company. R&D tax credits was taken away in 1981. tax credits are different than tax deductions. Tax credits is money in your pocket. It literally is cash in your pocket, so to speak. I'll show you how. Basically, in 2015, they let it come back, but between 81 to 15, the only people they let have tax credits is pharmaceutical companies. Now everybody can do this, and they didn't blast this out. They didn't say everybody gets to do this, but you can do this. And by the way, if you have your own business right now, fantastic. I'll show you how it works. If you don't have a business, you're a W-2 and that's your only income. Remember, you can take advantage of this. We're going to show you how to do this and how to make this thing work if you'd like to. Some great ways to do this. All right, real simple. With the R&D tax credit, it's research and development. Anything that you do where you're researching or developing something to increase your business or increase what you do. To give you an example, when you go to a CE course, anytime you're looking at new instrumentation, new techniques, all of that is research and development. If you have staff that you need to have them train on that kind of a thing, you can actually have them go and train in office. If you're doing procedures in the office, any of that education, research on it, development on it, that's all R&D. It's a dollar for dollar exchange. So when I talk at a group like this and they're here for 30 hours and 3 days, their company is going to pay for them to be here. So my company would pay, it's paying for me to be here, where it buys the rental car, it pays for the hotel, pays for food, that type of thing. So I'm getting tax deductions that way. But on the other hand, what we do is we can do research and development while we're here, which means that I get all the tax deductions, but at the same time, all the hours that I'm spending here, I get paid for those hours. Now, how do we figure it out? You have to be certified to do this, and we are. And so we look back over the last year. How much did you make? How many hours did you work? We do a division on that. Let's say you make $300 an hour. If you're at a conference and you're spending 30 hours there, you get tax credits at $300 an hour, which means you get $9,000 for those 30 hours as tax credits. Now, when we look at your tax liability, and let's say you had $50,000 in a tax liability, if you accumulate $50,000 in tax credits over the year, that applies directly to your taxes, so you don't owe any taxes. If you paid quarterly and you paid $50,000 at the end of the year, but you have $50,000 in tax credit, IRS has to send you back $50,000. Do you like the sound of that? Yes or no? Let me give you another example though. When we have our clients come to us and say, I want to start doing the tax deduction, we can go back 3 years, get all their tax credits for the last 3 years, just a paper trail. Oh, and by the way, if you have employees, we can take all of your employees, any R&D that they do, we can include that for you too. And you get to get their hours at your rate, not at their rate. So it's something very powerful. If you like the R&D, come by, talk to me. I'll tell you some things we do with that. All right. I'm not going to get into the license protection, but we have some amazing things we're doing right now with HIPAA, OSHA, protecting your license so you do not get actually sent into the board where they're going to take a look at your license. We protect it so your license will not be, even if you're a W-2 at a clinic or another office, we can protect your license so that it will not be reported to the NPDB. Last thing I want to do is this. That's the end of the education. Just to show you and wrapping this up, how we do this, it's really simple. You can go to attorneys and do this in piecework and have attorneys do all these different things for you. What we decide is we're going to do a little bit different. If we did that, you could spend anywhere from $25,000 to $50,000 or more dollars. My own accountant, one of my accountants I use right now, came to me and said, I need to get a trust. The guy just told me I need $15,000 to put this trust together. Not the case. The way we do things is totally different. So we actually have clients come to us and they say, we'd like to get this, this, and this, and we put it together for them. And the way we do it is we do a one-time fee of $13,400. Now, even though that doesn't sound like a lot of money and it's something that you can do, it's generally, just so we're clear, it is a tax deduction because it is legal services. But when we speak to a big group like this, we say, let's just make this. What we do is we save money by speaking to obviously a bigger group. It's less marketing for us. We say, how can we fix this? How can we make this work? And here's how we do it. We have at an event like this, there is a deduction on that of $5,000. So the total event price is $8,400 to do all the things that we're going to do for you. And let me break it down for you so you get a real clear picture on this, because this should be a no-brainer. The things I've talked about, no-brainer to go get this done somewhere. But if you wanted to work with us, and we are the experts at this, here's the way we break the $8,400 down. Real simple. $6,000 of the $8,400 is set up as a one-time fee. That's it. And the one-time fee is real simple. We will create all of your entities the rest of your life for free. It doesn't matter. Wills, trust, S-corps, LLCs, PLLCs, FLPs, any entity you want, we'll create all those for you the rest of your life for free. The second part is the 2,400, and that is a monthly fee. And it's $200 a month or 2,400 up front, because we're going to do a lot of legal work for you this first year. We actually included in for the first year for everybody. After the first year, remember the 6,000, you're never going to have to pay that again. But after the first year, if you want to put the 200 a month on hold, you can do that. It's just the first year it's going to happen because that's what we need to do. Having said that, the things we're going to do for you is going to be amazing. I get people that come to me and say, well, I heard that for when we have a corporate meeting, we have to write minutes. Yes, you do. IRS stipulates you need to do at least once a year, but we will write all your corporate minutes for you for all of your corporations and send it to you. All the forms that need to be filled out for the 7 forms, we fill those out for you. But more importantly is that you're going to have us there for you to help you. And we're going to be on staff for you. So you're going to have asset protection attorneys. You're going to have tax consulting. Our entire staff is there to help you, and we'll be on retainer for you. And it's a wonderful experience to be able to work with us as we go through and help you through this process. Ultimately, though, we want this, as I said, to be something that's a simple process for you, so you don't even have to pay for this. So not only is it a tax deduction, but for those of you that come and see us today and want to register with us, we're going to set you up. It takes about 3 or 4 minutes to do it. It's a very simple process. There is one form, and it's a simple form to fill out. But once you fill that form out, 3 or 4 minutes, you're done, you're in the system, and we start working with you right away to put things together for you. We guarantee you that if we don't save you at least the $8,400 in this first year, then we will cut you a check for whatever we didn't save you. You're not going to have to pay for this. You're going to get your $8,400 back. We're so confident in our ability of being able to save you money that we have no doubt that we can do it with anybody that we work with. We're able to do that. This is the last thing I want to share with you is this quote. And basically what the doctor is saying is that his whole life he's worked and studied to help other people. And it's about time to start working on my own family, my own assets. And he said, the fact that I can sleep every night and go to sleep and not have any more worries, and the fact that he's able to have attorneys at will where he can talk to them, they're on retainer, an amazing experience. And this is something we know we can help you with too. Okay. First of all, did you enjoy the presentation? Thank you. Here's what I'm going to do then. For those of you that already see this, you're saying, listen, this is something I've been looking for. I need to do this. Outside this room, we have a little table out there. My wife, Jarrett, here is another one that's working with me. We're going to be out there at that table to help those that already know you want to do this. Drop by, talk to us. We can get you set up right away. You're going to get a portal. We'll send you a text right away. It'll be a portal that you go in and start entering some of your information, and we can start working on doing what we need to do to help you out. Eventually, what we're going to do is text you or call you sometime in the next day or two, and we're going to try and set up a time where we can actually do an onboarding call. It takes about a half hour, and we're going to actually design your own personal program. So we focus on asset protection, estate planning, and tax deductions. We draw a blueprint for you and say, here's the blueprint we feel is the best for you for what you're doing, your stage in life, your assets, what state you're living in. We do it all individually for every single person. And we'll start working on that right away for you, but we'll have that call sometime in this first week also. So those that would like to do that, talk to us, come out there to the table. If you're not able to talk to us right now, we're also going to be in the exhibition room where all the exhibitors are, and we'll be in there. You can come and talk to us in there too, okay? Other than that, thanks for your time. Those that did fill those little 3x5 cards out, we'll come around and collect those, and our office will call you, contact you, get your information, and then what we're going to do is tell you what you can do as far as how much you can charge for rent with that program, okay? So thanks for your time.